What were the main contributing factors to you guys hitting profitability on a net income basis? And how confident can the street be that you continue on this arc of increasing profitability?
Ed, thank you for having me on. The main contributors to the profitability is that we finally reached the scale in our non-lending businesses that they are now profitable. And so we have three profitable segments. When I joined the company 6 years ago, we were primarily a lender. That's a very profitable business for us. We've entered the technology platform services business where we enable 140 million accounts throughout the United States and LATAM to do payment processing as well as core banking technologies and a number of other financial services technologies that we use at SoFi, but we also sell to others. And then our third segment is our financial services segment, which consists of products like SoFi Money, which is a checking and savings account, SoFi Invest, SoFi Credit Card, SoFi Protect, which is insurance. Those businesses required a significant amount of investment over the last 6 years, but we've now reached the point where they're 40% of our revenue in the fourth quarter compared to lending at 60%. And they're profitable. And so that inflection point hit this quarter. And as we go into 2024, we believe the businesses will be 50% lending, 50% tech platform and financial services. And with all three being profitable, the profitability is sustainable.
I'm trying to understand that guidance. So you're basically saying 50% compound annual growth on the financial services business over kind of this pretty wide window, 2023 through 2026. What gives you the confidence that you can see that far into the future in terms of how your company will grow that segment?
Sure. Just to clarify for viewers, I was suggesting that we'll have 50% of our revenue from lending in 2024 and 50% of our revenue from the two other divisions combined, the technology platform segment and the financial services segment. In terms of our longer-term revenue growth outlook, we are forecasting 75% growth in the financial services segment in 2024 and 20% growth in the tech platform. From the 2023 through 2026 time period, technology platform will come down to 50%, and technology platform will be mid-20s, and the financial services segment will come down to 50%. And the reason we could see that is because we understand our customer acquisition cost, how much we spend on marketing, and that drives the adoption of the products, and then they monetize at a rate that we've seen over the last couple of years. And so they're pretty strong leading indicators of what the future brings from a growth perspective.
One thing, of course, on your call that you made clear to analysts is, look, let's face it, no economist has got this economy right in the last couple of years. How do you feel about the macroeconomy, Anthony?
Yeah, we're very conservative about the macro outlook. Specifically, I don't believe it will be the case that we could have 6 rate cuts, which is what the forward curve shows, and a strong economy. I think if we actually get the 6 rate cuts, it's because we're likely with unemployment above 5% and likely with contracting GDP. I think it's more likely that we'll have fewer cuts and maybe a stable economy. But coming into October, many market pundits were talking about higher for longer. 90 days later, they're talking about 6 rate cuts. It's such a bifurcation of views. It's really hard to know what the real outlook is. And so we're taking a very conservative view, and we can do that given the diversification that we have on the lending business and with the other businesses. So we're going into next year with tighter credit and also lower expectations. In fact, we're really just forecasting maintaining our revenue in lending, not growing it, and the other businesses driving the growth that I mentioned.
And with that sort of growth, you still have that goal of a 30% return on equity. You still have that goal of being in the top 10 in terms of financial institutions here in the United States. What gets you there in terms of your underlying investments that you now need to make, Anthony?
Sure. In 2023, we were able to grow our revenue 35%. We just hit our long-term EBITDA margin of 30%, which is what's required to get to the return on equity of 30%. Now we just have to scale the EBITDA dollars against our book value. We grew tangible book value by more than $340 million this year, and we're looking to grow it even faster next year at $300 million to $500 million. And so the profitability of the business is there. Now it's about just scaling the revenue, which will scale the returns on equity to that 30% level that you mentioned. We've been in these businesses now for 4 to 6 years, and we have pretty good leading indicators of what it takes to drive their growth, and that's what's giving us the confidence in our forward outlook.
Anthony, our colleague Paige Smith on the fintech team is talking about your technology business. Our colleagues at Bloomberg Intelligence are talking about your technology business. This is the Bloomberg Technology show. What are we talking about when we say that SoFi is a tech company? What is the strength that you have there?
Sure. Obviously, we have to build our own technology. We're a financial services company with no physical locations. And so the only way our products are delivered is through the mobile app or desktop services. So by definition, we have to have technology to do that. In addition, we have to have processing capabilities and operating systems. We use for processing a company that we bought, Galileo, back in 2020. Galileo is powering about 140 million accounts in the United States to do payment processing on debit and ACH rails, but also it's developed a whole suite of APIs that allows a developer to tap into those APIs and build account opening or a direct deposit or 2-day early paycheck or payment risk platform. In addition to that, we have a technology platform that's a core banking technology called Technisys. It's really the operating system for products. It's a multi-product platform. We use it for SoFi Buy Now, Pay Later. Those are the two main products that we sell to third parties. And as I mentioned, servicing about 140 million accounts in the United States and LATAM today.
Anthony, I think we've got to talk about the share reaction, right? Your gains at holding at around 23%. You know, I talked about that psychological milestone of net income profit. But do you finally feel like you're getting some credit? Because you've been talking about this plan for a little while. I have a sense of deja vu. We're talking about the same things now as the two previous times you've been on the show.
Sure. I think that the inflection point in this quarter is, one, hitting our long-term margins of EBITDA at 30%. So that gives people a longer-term view on what our profitability could be. Second is 40% of our revenue came from the technology platform business as well as the financial services business, which means 60% came from lending. And so as we go into 2024, we're calling for that split to be 50-50, as I mentioned. That's also an inflection point. People have been waiting for that for a while. And so while there's a lot of talk and debate about the loans and fair market value accounting versus cost accounting, the reality is that our business is much more than that. And we're starting to get the perspective from investors about that broader diversification. And it's not by accident. We embarked on a strategy to be a one-stop shop 6 years ago for all your financial services needs. Our mission is to help people achieve financial independence, which means we have to help them get their money right. And we can't just do that in one product. We have to do it across borrowing, saving, spending, investing, and protecting. And what you're seeing in our results is that strategy playing out in diversified revenue and high profitability 6 years later.
Interestingly, not in crypto anymore. But interestingly, what I'm taken with on a day like today, where we see the Amazon iRobot merger have to be put on ice, with your background as someone who helped lead the overall investment banking offering over at Goldman Sachs when it came to TMT, when you're thinking of your own acquisition strategy, can deals get done at the moment in the world of tech, Anthony?
I think they can get done. We're not focused on doing deals at SoFi. We're focused on our strategy and executing organic growth. We feel like we've reached the point now where it's ours for the taking, and the opportunity for us to be the winner that takes most is completely up to our execution. But more broadly, I do believe there's still M&A that will happen across both technology and financial services. I think financial services is probably a little bit more challenged because of the regulatory backdrop than technology is per se. But deals are getting done. They're just harder to get done, and they're going to courts. But in court, people are winning. I think what you've seen in some of the breakups is really about business performance, not about regulation, and businesses underperforming relative to expectations, and therefore buyers being able to get out of those deals.